What's going on, everyone? Today we're looking at March's local market data and why I think we are seeing a huge rush to both buy and sell right now. Plus some ominous signs and speech from the Fed that we may be seeing cracks in the housing market. That's all coming up in today's market update, so let's get started. Hey, thanks for joining me today. I'm Rick Harrison with MVP Realty in Southwest Florida, and on this channel, I bring you the latest information in the economy so you can make better decisions when it comes time to buying, selling, and investing in Southwest Florida real estate. So please, if you haven't already done so, subscribe to the channel and hit that bell so you don't miss out on the data, tips, and analysis keeping you ahead of the market trends. All right. So I've got quite a bit of local month-over-month data in today's update and some really important news from the Fed and real estate data companies that's showing even the mainstream media and real estate gurus are starting to shift their perspectives on the future of the housing market. So let's get started with the week-over-week local market stats. All right, so for this week's 7-day market update, we're looking week over week. Last week, we were at new listings at 788. This week, we went up to 904, so that's up 15%. And as you're going to see throughout this theme, and as I mentioned in the beginning of this update video, we're going to be seeing why I think there's been a rush for both buyers and sellers. These numbers are showing that right now. Now, compared to last week where we did dip down in the new listings, we went from in the 800 range now back down to the 788. This week, we're back up to the 904, so we're actually increasing. So more listings are coming on the market, and I think we're going to see that trend over the next several weeks with interest rates continuing to rise and sellers getting nervous that they're going to be pricing buyers out of the market, which means they're not going to be able to take advantage of these historical prices for selling their home. Also, sold went from 947 last week up to 1296. That's an increase of 37% week over week. Now, with that huge increase, that just means that homes that were pending last week have finally closed. So these are things that we would be seeing. These are sales from or contracts that went under contract from over a month ago, typically 30 to 45 days for closing, right? So this is just signs of what happened over a month ago. Now, pendings did go from 1330. They did decrease to 1277, which is only down 4%. What this is showing between the solds and the pendings is that even though a lot more homes closed over the past week, we did see almost the same amount come back with a slightly less coming under contract this week. So that's showing us that pendings are down, solds are up only because the closings have actually occurred now. So let's now take a look at the total inventory breakdown. Again, I think you're going to be seeing this theme throughout. Single family homes, last week we're at 2097. This week we're at 2208. That's a gain of 111 over the past week. Condos went from 1025 to 1086. That's a gain of 61. So just comparing the net gains from last week to this week. Net gain last week, we had 49 total new listings. This week's net gain is up 172. So we're seeing more inventory come on and staying on. Multifamilies. We're also seeing it here too. Last week we're at 88. This week we're at 95, which is a gain of 7 or up 13%. Foreclosures, on the other hand, 32 to 29. So we lost 3. That's down 10%. But for the amount of foreclosures that we already have in this market, which hasn't been very many yet, and we don't know if there will be a ton more coming on or not, but as of right now, just losing 3 is quite a significant change for just the small numbers that we are looking at. So that is a pretty big jump in a net gain of 172 new listings on the market this week. So we'll have to continue watching, but so far this has been a trend. It's been about 4 weeks in a row we've been seeing a net gain. 3 weeks in a row that we've been seeing a net gain of new listings coming on versus what's leaving the market. Interest rates for this week as of 4/4. We went for NerdWallet went from 4.803% up to 4.87%. That is up 7 basis points. Bank rate went from 4.56 up to 4.91%. So now both bank rate and NerdWallet are pretty close to the same now, and both are getting very close to the 5% range. So we will continue watching that, but I'm expecting that to continue over the 5% range in the next couple of weeks. especially with next week. We have next Tuesday and Wednesday, we have the PPI and CPI data from March coming out, and I expect those to be quite a bit higher than previous month. All right, now let's take a look at our month-over-month local data for Southwest Florida. This is as a whole, the whole MLS. This is not one city specific, but we will be looking at the charts from the past 3 years. So new listings, as you can see from the February to March, there was quite a significant spike, almost up 1,000 new listings. So that is very significant since we've been seeing for 18 months more. Listings have continued to decline over the last year and a half. And now we're starting to see it go the other way, all the way from January to February to March. And now I'm guessing we're going to continue seeing this trend going from March into April. Homes for sale. Again, this just goes, there's already been low inventory. The amount of inventory that's been coming on has been leaving just as quickly. So homes for sale have actually continued to decline. Here also quite significantly, down about 1,000 as well. Then we move on to the average sale price. Here we're seeing a peak. Now, I know we've been talking about, the potential for a lot of this stuff to start to slow down and the market to start to slow down. I think what we're seeing in a lot of these stats and these market and these graphs is what I've been mentioning, the rush. Sellers are getting worried that buyers are getting priced out. They're going to miss out on these historical prices that they can get and net gains that they can get for their homes. So they're all starting to flee to put their homes and rush to put their homes on the market. At the same time, we have buyers who are rushing to lock in low interest rates with the rates starting to increase again. Going into the 5%, a lot of them are trying to get a home under contract as soon as possible because they're worried that they're going to be priced out of the market. So in my personal opinion, a lot of this is really fear of missing out, FOMO. But we'll have to see if that actually is the case. Again, that's just my opinion, but based on what I've been seeing for data, that's where I think we're at right now in the market. Closed sales. Again, this also spiked over the past month. It went up almost another 1,000 closed sales. Now that is in spite of the fact that obviously the homes for sale have continued to decline quite significantly and the prices have continued to increase quite significantly. Closed sales are now spiking. And again, that just goes back to the fact that buyers are rushing to try to get a home under contract at a good rate and something that's still affordable before they're priced out. All right, let's go right into, I just want to give you the headline highlights for those of you who don't want to stick around to hear the stories or listen through the micro stories. Here's the headline highlights. You can pretty much gather what the story is going to be about from the title. So job growth signals more hawkish Fed hikes. That's coming in the near future. Fed doesn't meet again till May, but as the way the economy looks right now, it does look like the Fed will be a little bit more hawkish in their next rate hike. Dallas Fed also, they're starting to see signs of a housing bubble. So we'll take a dive into that story. Home flips are flopping. And we also have mortgage delinquencies increased for the first time in 9 months. So we'll look at those two stories. The Atlanta Fed also says that Atlanta is now unaffordable according to one of their pricing tools, their home affordability tools. And then Redfin also sees slowdown in online searches, being one of the leading data providers for online searches. So let's dive right into the first story here. Unemployment hits pandemic low in March, but uncertainty looms ahead. So this is each one of these stories is going to lead right into the next one. So the U.S. labor market extended its streak of unprecedented growth, adding 431,000 jobs in March, which is a good sign for the economy. Unemployment rate also hit a new pandemic low of 3.6%. So both of those are saying that the economy is strong, and that is what the Fed has been saying. If these numbers are correct and if the data is correct, that is suggesting that we're in a strong economy, which means the Fed will most likely be more hawkish at their next meeting. And instead of doing the 0.25 basis point rate hike, they're probably going to go into a 0.5 basis point hike, which is definitely going to put the mortgage rates, I shouldn't say definitely, but I'm almost certain that it will put the mortgage rates over 5%. This is also raising questions about the job market sustainability with inflation at 40-year highs. So just like everybody's been speculating about the housing market, things can't last like this forever. They're saying the same thing about the economy itself and job growth. Job growth cannot continue on the track that it has been. We're almost at full employment, which I'm not sure how they're measuring that, but that's what they're saying is we're very close to full employment. We've actually recovered most of the jobs that we've lost in the pandemic. So we're going to probably be starting to see a slowdown in the job growth as well. All right. Real-time market monitoring finds signs of brewing U.S. housing bubble. So this is right from the Dallas Fed, right from their site. There's growing concern that the U.S. house prices are again becoming unhinged from fundamentals. Now, the word unhinged is a very key word in their speak in their article that they used. But the shifts in disposable income, the cost of credit and access to it, supply disruptions, rising labor and raw construction materials are among some of the reasons. We already know that. If you've been watching my channel, you already know of all these things. But real house prices can diverge from market fundamentals when there is widespread belief that today's robust price increases will continue. So it's almost like it's a vicious cycle. It's fueling itself. And this is what we call FOMO, fear of missing out. So you feel like the housing prices are going to continue rising, so you rush to buy and lock in the rates, which again then pushes the house prices up, and it makes more people feel like they're missing out, so they rush to buy, and it just creates a cycle of endless buying where we're just inflating the prices of houses. So that's what the Dallas Fed is worried about right now. We will have to monitor this and see what else they come out with, see any other data that they're coming out with. But I do think that this is something that is a real possibility in the market right now. And I personally feel like it's not sustainable. The growth is not sustainable. The prices are not sustainable. People are getting priced out of housing, but at the same time, rent is rising at the same time too. So I'm just wondering where all of these buyers were 2 or 3 years ago in 2019, and then all of a sudden we had this huge rush, and it just kind of compounded on top of itself. So we'll have to see what ends up happening, but just wanted to put my own opinions and perspective out there. Adam, home flips up, profits down in 2021. So this goes right along with what they're talking about is the FOMO. The prices are starting to rise so much that even home flippers are losing their return on investment. So the number of home flips in 2021 rose 26% year to year. So that means a lot more people were getting into investing in houses and speculative investing, which is a sign of a housing bubble. If you look at what the 4 major signs are, that's one of them. More than average investors entering into the market. Each flip fell 3%, the lowest level since 2008. That right there, 2008, if you remember what happened then, you would know that that is an ominous sign that it hasn't been this low since 2008. And a 20% drop in return on investment. So even as quick turnaround sales by investors shot up, so that's when an investor buys a house real quick just for the price because they're speculating, they feel like the price is going to increase very soon thereafterwards. You buy the house, you sit on it for a couple months, you wait, and then you sell it for your profit. Even with that, 2021 gross profit margins sank to their lowest level in more than a decade. So that's the lowest margin since 2008, as I said. So this is in 2021. This isn't even looking at what's already happened so far this year, which prices have continued rising. So we'll have to see what those numbers look like, in the next quarter or two. We'll have to revisit these numbers. But higher prices and smaller margins, plus there's higher risk right now. It's spelling, a lot of trouble for any speculative investors right now. Mortgage delinquencies rose for the first time in 9 months as well. So they're on the rise, driven by a 97,000 rise in early stage delinquencies. So those are mortgages that are 30 to 60 days past due. That rose, and this is according to Black Knight, which is the leading data provider on mortgages and real estate. The number of properties that are 30 or more days past due in foreclosure reached approximately 1.95 million nationwide. So We were talking, a lot of people have been talking about the housing shortage. There's almost 2 million homes right now that are looking into the early stages of foreclosure. So if something like that were to hit the market, even though the word is that we're 6 million units behind on housing. If 2 million were to come to market in the next 6 to 12 months, that would be a huge influx of inventory, and that would drive prices down in the housing market. Um, you know, a lot of it could be bought up by investors as well, but just that amount of housing coming to market where we're so limited right now, where there's less homes available than there are real estate agents in the United States. So something like that coming to market would make a huge dent in the inventory and demand. So while total U.S. foreclosure starts hit 25,000, up 541% from the same time last year, Black Knight revealed. So going again, if it just goes back to, the last 2 years, homes that would have probably been under foreclosure were paused. So now we're starting to see that start to catch up a bit, and we're going to see it catch up more. I do think we will see more foreclosures. Next story, Atlanta now considered unaffordable for home buyers, according to the Atlanta Fed report. So a recent affordability report released by the Federal Reserve Bank of Atlanta shows the effect those increases have on our ability to buy a house. So one of the Federal Reserve studies showed that this is the first time in the history of our index the share of income needed to afford the median house price jumped above 30%. So whenever it's above 30%, that means the market is unaffordable. Another area that was also cited was Nashville, Tennessee, which also had some of the steepest increases in the United States. And then finally, the surging mortgage rates and home prices sideline more buyers. So this is right from Redfin. Fewer people are starting online home searches and applying for mortgages than this time last year. And year-to-date growth in home tours remains far below 2021 levels. So an increasing share of sellers are also reducing their prices after, which if you take a look back at the housing data, the 7-day market update for this video, you go back, you'll see that the price reductions are in the 300s now. And if you go back to some of my videos from just in February, you'll see that home price reductions were around 180 or so. So they've doubled since just 2 months ago. So that's a pretty good indication that people are speculating on their home prices. They're hoping to get more than that's worth and expecting that prices will just continue rising. And the market is now dictating that may not be the case anymore, especially with mortgage rates increasing and buyers just being priced out of the market. They can't afford to pay more than they were before when mortgage rates were lower. All right, let's move on to the wall of worry. Pretty much the same that we've been looking at, the future Fed hikes and the mortgage rates. That's going to be an affordability problem. The big thing that's coming out next week, Tuesday and Wednesday, I won't be able to do it on the Monday market update next week, but April 12th is the CPI data released and the 13th is the PPI data released. I am expecting those to be much higher, especially with everything that's going on with now that we're going to see the gas prices probably be put into the CPI data. PPI data, we have a lot more of the supply chain issues happening with Ukraine, China shutting down again. So those will probably be higher, if not this month, than next month. But PPI is a leading indicator and CPI is a lag. Foreclosures and home sales and inventory, the market shift, I think we're seeing that, but we'll have to keep an eye on it to see if it's actually a shift or it's just a trill right now back and forth. And then the inverted yield curve that did happen, several of them have inverted, and many of them have been considered leading indicators for other yield curve inversions like the 210. So if that is an indicator of recession, even though usually is an indicator of recession 2 years out, we're in a different world right now, and things are not normal as they used to be. So we could very much be in a recession and we wouldn't even know it. So we'll have to keep an eye on the economy and see how much it's slowing down with GDP growth and all that stuff. And then also keep an eye on the job reports that continue to come out. And then, of course, China shutdowns and Ukraine war. That's the food and supply chain. President Biden did come out and say that food shortages were going to be a real thing. So if you hadn't heard that already, you're hearing it here. That is something to be aware of. May not necessarily mean that food will be exactly short. Could be just really high prices. But he did say that. So I would just, make yourself prepared in whatever way you can or whatever way you feel is necessary. But that's just what I think. What do you think? Please let me know in the comments. I'd love to hear what you're seeing in the market in your areas and where you think we are headed in the rest of the year. Thanks for watching, and if you enjoyed this video, please hit that thumbs up button to let me know. And don't forget to register on my site to get access to loads of exclusive tools, data, and content like foreclosure and open house lists, buyer and seller guides, calculators, and access to our Southwest Florida MLS. If you have any questions, please don't hesitate to give me a call or send me a text at 239-310-5478. And if you prefer email, you can send one to rick@swflrelocationteam.com. Thanks again for watching to the end, and I hope to see you next week.